Economic momentum is waning, says our next guest. How is this going to translate to the markets? Well, right now, Bitcoin, for example, looks strong. It's just surpassed $70,000. So we're going to be talking about risk assets like Bitcoin, tech stocks, and the S&P 500, and a few sectors as well with our next guest, Chris Vermeulen, Chief Market Strategist at thetechnicaltraders.com. For context, Chris is still long the markets, but he sees a financial crisis brewing. This is what he told me offline. We're going to be talking about what this financial crisis means. So, exciting episode. Tune in. Novium. This episode is sponsored by Novium, a very interesting pen. Stay tuned for a message. It's a hover pen. It's probably the coolest pen I've ever seen. So stay tuned for a message on that. Chris, welcome back to the show.
Yeah, thanks for having me, David. Always a pleasure.
Well, let's just start from what I just said. You told me offline you're seeing signs of, quote unquote, maybe a financial crisis brewing. So walk us through these signs. Let's have a discussion.
All right, sure. Yeah, let's. If we take a look at things from a really high level, there's a cycle that goes through pretty much everything in life, but the stock market, the financial risk assets, we have obviously peaks where if you were to implement capital near the top, you have maximum risk, which I believe we are in this opportunity right now of if you put money to work, you could lose a lot of money or suffer a heavy drawdown. And then we have cycle lows, and understanding these cycles is part of it. And I believe for a while, you and I have been talking about this, David, that more or less we're kind of in a stage 3 topping phase. And there's 4 stages to the market. Long story short, we don't need to cover all the details, but I believe we are in this topping phase. Things are starting to happen in terms of certain assets coming to life, and different momentum things shifting. But as you mentioned, some of the big picture, when we look at what's going on with some economic data and economic cycles here, we've got the unemployment rate when it crosses above the 24-month moving average, which is the red lines on this chart. We pretty much always have some type of financial correction, financial crisis, something. We never really know what it is until after it's happened, but we just know that rising unemployment typically leads to weaker times. And what's interesting here is, and I mentioned this many months ago, is eventually this whole beast of everybody spending money and buying toys and traveling and everything just being so overpriced, yet people are still willing to pay with all this inflation, they're going to run out of money. People are not good with money in general. Most people live paycheck to paycheck. I think there was a stat out there, 52% of Americans have less than $2,000 in their bank account at any given time. That's a major problem. And with unemployment starting to rise, there's going to be more people running out of money because they don't have any. And what's really interesting, David, is when we look at the aggregate excess savings in people's bank accounts from COVID, it shot higher. People got all kinds of money, funding, businesses did well, savings just skyrocketed for people. Here we are now, 2024. We're in the hole. And I just read a report about how credit card debt is starting to skyrocket because people have burnt through their savings. Now they have to borrow money and they're living, on a credit card. And this is the beginning of, I think a major downturn in the economy of sales for businesses are going to slow down. Oil's starting to get hit really hard, which maybe we want to touch on later, but I think that's because people are starting to see the economy's slowing. I think a recession is coming. Fewer products sold means fewer products shipped. Oil is used in most products in some way, at least to ship it. So all these things are coming around, and precious metals are coming to life, which are one of those last commodities that do very well just before we see a recession or a stock market decline kick in. So those are some of the big picture kind of things that have run out of steam and have actually changed directions as people's savings are now and in unemployment.
Before we move on to the next topic, I want to spend a minute to talk about our sponsor today, Novium, which has a really unique and interesting product, possibly the coolest pen I've personally seen. It could be the perfect Father's Day gift or a cool, thoughtful office present for a colleague or a manager. The hover pen defies gravity and levitates on a stand with the use of magnets, making it an elegant statement for any office or home setting. This pen is crafted from aircraft-grade aluminum, which gives it a polished finish, and it's available in 4 different colors. The hover pen is refillable and offers a more comfortable and pleasant writing experience than most other pens due to its ergonomic design. Novium's hover pen was also one of Time Magazine's 2022 Inventions of the Year, And it has recently wrote out its Hover Pen Future Edition, a fountain pen like no other I've seen, or you as well, probably. So act now. You can get 10% off your Hover Pen using the code David Lynn. Free international shipping is also available to most destinations. So use the link in the description down below or scan the QR code here. Just check it out, look at it, take a look for yourself. I think the pen speaks for itself. Good summary, Chris. I want to talk about savings and what this means. So you're right, it's come down. Now, there's a few ways to look at it. First is that while maybe people are spending money, that's why their savings rate is going down. That could be good for the economy, right? You want consumption to go pick it back up, especially since nobody was spending money. Well, not nobody, but people weren't spending money during the pandemic because they were locked down. Therefore, the economy didn't do too well. The other way to look at it is you're right. They don't have money to spend. They have to use their credit card. And actually, this stat may support that point. Delinquency rates on credit cards are rising. They have been. They're now at the highest level since 2011. So which makes more sense to you, Chris?
Well, I mean, I think people are spending money on cards, and with employment going up, there's going to be more people having more delinquencies.
Mm.
We're already starting to see that even on mortgages for homes. So all of this kind of is connected. As people run out of money, and they spend what they had, they're going to go to debt, and then of course they're not going to be able to pay their debt because they don't have jobs or don't have enough income. They can't manage it. They're outliving their income level, whatever it is. I think all these things are pretty accurate as what's going on. I mean, I would say the momentum has shifted from kind of a feeding frenzy of people, as you mentioned, not being able to spend money during the first little bit of COVID, and saving up, and it created this big bound. But now we're actually lower than we were. So people are poorer than they were before, other than assets that they hold, like a home or something like that. But I think this is a very negative sign for the economy.
At what point do you think this is going to start translating into the stock markets? This downturn in the economy that you're talking about?
I think it already has. I mean, really, this chart actually topped out right almost when small caps like the ARK ETFs and
Mm.
a bunch of different like small cap stocks in general topped out. Simply because a lot of aggressive traders move into the market when they've got excess money. They want to bet and buy these high risk or lotto ticket type of stocks. And as soon as more or less this started to top out here, I think we started to see the market start to sell off. And this dropping down in value, you're right. It has an angle that it could be good for the economy. As this drops, people are spending money stimulating the economy, which is true. But for when it comes to the stock market, I don't think this money was really flowing so much into the stock market. I think this was flowing more into real estate and potentially some different assets, versus just the stock market. So that's kind of my take there.
I want to come back to the markets and fundamentals in just a bit, but this is interesting news that I need to get your opinion on or reaction to. So, Roaring Kitty is back again. We talked about him last time. He's back on the news. Keith Gill is his real name. E-Trade, the trading platform, is now having internal discussions, according to CNBC, about whether to ban Keith Gill, the meme stock trader who just disclosed a big position in GameStop, from the trading platform over concerns regarding potential market manipulation. The Wall Street Journal reported on Monday. So GameStop, as you know, spiked earlier this week because Keith Gill went on social media and disclosed he had, I can't remember exactly how much, but he had a lot of money in that position, and then things pumped the next morning, and then it came back down. So this is what's moving the markets. We're talking about the markets. It's things like this, not the
Yeah.
entire market per se, just one particular stock. But this is what. And by the way, yesterday, I don't know if you're aware, but there was a technical issue at the New York Stock Exchange, and
Yeah.
stocks like Berkshire Hathaway shares A, Class A shares, were down 99.7% at one point. I think that issue got rectified, but someone sent me
Yeah.
a screenshot of that. That must have given people a heart attack. So I just want to get your reaction to what's going on this week.
Yeah, when it comes to GameStop type of stuff, I mean, I think they're fairly contained. It's one stock, it's a bunch of hype. There's always people breaking the law and breaking the rules in the financial system. So I don't put too much weighting. I don't put any weighting into individual stocks around that. When it comes to the NYSE having the glitch, and obviously that stuff. I think that could have been part of why we started to see the stock market sell off. We saw some pretty good selling in the morning. I think it was 40 stocks got halted and all kinds of stuff. This just reaffirms, like, the Fed not that long, like just before, what was it? Silicon Valley Bank went, more or less bankrupt. The Fed came out and said, oh, everything's stress test. The banks are solid. And then like 48 hours later, a bank goes bankrupt. And they have to like bail it out. This just goes to show how brittle like the financial system is. A little glitch and one of the most solid companies, Berkshire or investments, can lose 99% of its value. So, I think things are really fragile. I think there's going to be a huge banking crisis. I think there's all kinds of stuff that is going to kick in. And this is why it's super important, I think, to protect your capital and not just ride out any storm, because this storm that's coming is going to be just like all those other nasty storms. A lot of people still remember the 2008. They remember the tech bubble burst. Those are the two that I have lived through. And, we're going to have something just like it again. Either you protect yourself or profit from it, or you ride out an absolute nightmare of a scenario. And who knows what's going to break. Every time there's a different reason for a correction. Stock market might break. There could be a banking system break again. It could be a combination. So I think it's just important to be aware that this is part of the game. Nothing is 100% safe, but you definitely have to be aware that we're getting into fragile times. Even the Toronto Stock Exchange, I think they said the volume was down. I can't remember what they said, but it was very, very low. They haven't seen low daily volume levels on the TSX at this level for a very long time. It's just dried up. No one's really that interested in the stock market right now, and the whole AI craze is getting re-energized a bit with Elon, coming out with his own, re-sparking that at NVIDIA and Intel, and I think AMD now trying to really get in there, take some of that market share. So it's definitely skewed. And this is what happens during a stage 3 topping phases. We have these crazy pops and drops and volatility.
Yeah.
And, something will be hot one week and then it rolls over. So these are all the signs that we have increased volatility and stability in the market. And it's kind of, really hanging on to what NVIDIA is doing, or the semiconductor space is doing a lot of the heavy lifting.
Okay, so you mentioned banking crisis. I know that's not what you're calling for. You're not saying it's going to happen now. You're saying that's one of the nightmare scenarios. But walk us through the logic of how it could happen. What kind of banking crisis are we talking about, Chris?
Yeah, I mean, if we were to kind of walk through it through a basic high level logical way,
Yeah.
is we have unemployment rates starting to rise. People have now burned through a lot of their savings.
Yeah.
They move to credit cards. A lot of banks have their own credit cards. Eventually, people can't pay their credit cards, so the banks take a hit for defaults. Eventually, then people can't pay their mortgages and they start to default. Now the banks are stuck with homes that they're not getting paid for, and then home values start to fall. And then the banks are backwards on homes and foreclosures. And it's just a big wave of just bloodbath after bloodbath. And the banks are the kingpins. They take all the debt and then they spend it all, and they don't even have the money, but they lend it out, and they go backwards on it. So it's just this big process. And this wave happens like over and over again, but they generally happen 5, 10, 15, 20 years apart, depending on the type of wave that it is. And most people don't realize it, or they don't pick up on it because they forgot about it, or they haven't lived through one yet. So it's just a cycle. When we go into a recession and businesses start laying off, this wave of defaults starts across the board, and it just carries through to the banks. The banks are the ones holding almost all the debt at the end, and if they're not getting paid on their debt and those assets are falling in value, there goes the banking system. They start to go bankrupt. So it's a big problem.
Let's take a look at some risk assets now, Chris. Bitcoin. So starting with Bitcoin, and then we'll get to stocks. It doesn't look like Bitcoin for now thinks there's a financial crisis, but we can talk about that. We can talk about why it's maybe moving in an idiosyncratic way, and maybe discuss where momentum looks like it's headed. So again, $70,000. What does the chart look like to you in terms of what is next?
Yeah, so this chart looks really good. I mean, in terms of it is put in a major basing formation. If I was to just draw on the chart, we've got a really critical level right through around this level on the chart. So it carved out a major base. It built a launch pad, which you could say this is a cup and handle pattern, which is one of the strongest patterns when it's built in a basing formation like this. And then it broke out of that level, and now it's rocketing higher. So there's a few interesting levels that we can look here. I think the most interesting one right now is if we kind of zoom in a little bit. I love to use Fibonacci extension because it is, I found, one of the most accurate ways to forecast where this price momentum, the strength, should carry us. And if we apply Fibonacci extension to this chart pattern, it gives us some upside targets of where Bitcoin should go. So the next stop, like this rally here, this pullback and rally, and now we've got this next little bull flag or pennant formation. These are all bullish patterns pointing to the next level, which is around $80,000. You can see 70,000 in change. If we hit that level and it has a little bit of a pause or hiccup there for a few days or a week or so, then we're most likely going to go up and hit this next target of 90,000. But depending on how far back we want to go, so that is a conservative view. I believe Bitcoin wants to go a lot higher. If we were to kind of look at this much larger picture here, and use the monthly chart and Fibonacci. This is kind of hard to see. I've kind of messed up the charts here. Let me just...
No, that's okay. Well, while you're doing that, it looks like it's gone above the upper end of that moving average. Does that look like an overbought indicator for you?
Like over here?
Yeah.
No, it's actually a high momentum move. If it can hold above this light blue line, that means it's in a high momentum move and it's primed and ready to keep going. So if this was the basing formation, I drew on the chart, on that daily chart, I drew a line right across this level on the daily chart. So this was the base that it formed. If we apply Fibonacci extension, which is the start of this breakout rally and down to this pullback we saw just a month ago, this projects for where Bitcoin could go, which is dramatically higher. This brings us up to about 87,000 and 106,000. So, I mean, this chart pattern is very strong, and I would say Bitcoin is rising more so. Like, I'm not a Bitcoin expert, but it is seen as an alternative currency. Gold is seen as an alternate currency. Both of them are going up. They both see problems in the markets. And I think that's why money's flowing into these. They're like, hey, I don't trust the dollar. I don't trust the stock market. And I think that's why they're going up, is because I believe they actually both see a crisis coming. And we typically see gold do very well near the right at the end of a stock market major top, which it's doing. And Bitcoin, I think, is carrying that same characteristic. And I think it's also a lot of the same investors, people who are into gold or into Bitcoin, because it's an alternate currency, right? And a lot of people into precious metals don't trust the system, they don't trust currencies. So this is the upside potential. There's a lot going here. Now there will be some resistance area at 100,000. Typically on whole numbers like 100,000, there's going to be sellers lurking up there. My general rule is if a target is above a major whole number like 100,000, I usually opt in for this level to take partial profits or move stops up, be aggressive, simply because what people will do and naturally do is if it rallies up here and they say, hey, if it hits 100,000, I'm selling my Bitcoin. I'm selling a chunk of it. So naturally, if it was to rally up, it's going to trigger all kinds of people, and it could create a pullback and a consolidation for several months. Or who knows, it could create a bigger pullback. But that's the next level. I think we could hit 100,000 on Bitcoin really over the next, based on this chart pattern, 4, 5, 6 months.
Well, I wonder if Bitcoin is also in a stage 3 topping pattern like it is with stocks. So I draw this parallel because, as you know, Bitcoin has been trading in tandem with the NASDAQ for a number of years now. In fact, if you overlay the NASDAQ on top of Bitcoin, you'll know exactly what I mean. So I wonder if you think if Bitcoin is going to go to perhaps 100,000, perhaps momentum is also favoring the NASDAQ and the big tech stocks for now as well. What do you think?
Yeah. So, I mean, we have seen, so this is going back to 2000 and I guess it depends on how far you want to go back, but I would say Bitcoin's been following the bottom chart here is QQQ, which is the NASDAQ. So they both pulled back together and kind of formed a base and started to move up. Yeah, there's potential. I mean, I'm still long the equities market, I think the equities market still has another leg up for another month or so. I think we're very close to an end for the stock market, but the trend is still up. People are still accumulating. Money's still flowing in. Um, I still put Bitcoin in its own category. I picture the stock market as an asset class.
Yeah.
I picture gold as an asset class, the dollar as a different, and I picture Bitcoin as its own. They may move in tandem at times, but they still, I believe, like, if we were to look at these charts, um, they follow very closely, but not always the same. And Bitcoin, I think, is a lot like gold and gold miners and silver, that at any point they can disconnect from moving with the stock market, because gold miners sometimes move perfectly in sync with the stock market. And then depending on the mindset and the fear levels, it can flip on a dime and it'll do the exact opposite. Stock market goes down, gold stocks rally, they become a defensive play. So Bitcoin has that characteristics, which I see regularly some days, that it can disconnect. So I look at it as its own beast, track it as its own value. Don't put weighting into other assets. Just focus on that one and its interworkings is kind of how I look at it.
All right. Well, on that note, let's pivot to the stock markets now. I'm not talking about meme stocks anymore. Let's talk about the broad stock markets. How's the S&P 500 looking? Is it the same thesis more or less as the NASDAQ?
It is. I mean, to me, it's got a very strong chart pattern. I think it's kind of had a reset. So more or less, we had a major trend reversal back here in November. We played this big move to the upside, but once it has a trend change, it usually likes to have some type of pause or digest, a little bit of a correction. And I think we've seen the same. We've seen the market reset. We saw a bunch of fear. We saw the VIX spike. We saw panic selling on the put call ratio. Now it's rallying up and it's forming, a pattern here that is a bull flag that is pointing to higher pricing. I can see the SP 500 rallying about 5 to 7% over the next month or so, which brings us in line. Same with the NASDAQ. I see about 6, 7% to the upside with the NASDAQ. And that brings us in line with seasonality. The seasonality chart typically shows the stock market tops out usually June to July, somewhere in that window. And this chart pattern says we have one more month. So that brings us right to July, which is right in the middle of the time when the stock market can top out. So I like the equities market still. All the signs are there that I think the long-term trends and the economy is shifting gears and, but we don't trade data like that. We don't trade big picture stuff. We trade the charts, follow price. But yeah, it looks really good. You can see here on our 30-minute chart on the left, lime green means the market is like panic selling. It's oversold, and it's usually when buyers step in. So we saw a wave of this. And typically when we have a wave of this type of selling, that's when it's cleansing the market. People are bailing out, betting on falling prices, and then the market shoots off without them and takes off. So we just had what looks to be a reset. And now the market, I think, is ready to move up.
Okay. So I think what I'm getting from this conversation we're having today is that short to medium term, you are still bullish, and in fact, you said you're still long, and so momentum is still on the upside for stocks in this stage 3 topping pattern, stocks and risk assets like Bitcoin. Correct?
Yeah.
Okay. So I think the question everyone's wondering, watching this, is what indicators should we look for a market turn? In other words, a top and then finally a stage 3 correction.
Yeah. So depending on your time frame, like we need the trend to turn down. We need a lot of selling. We need to see big, heavy volume selling to the downside. So we need a lot of damage to the chart. We need a huge correction to really kind of mute and kind of neutralize this uptrend that we've seen since November. The pullback we saw kind of in April really is just, it's a really controlled pullback. It was actually a very nice pullback in the market. It's reset things. It didn't do really any damage to the chart. But if we start to see the market go and break below this 5,000 level on the SP 500, if it starts to break and close below there, then I would say, okay, well, listen, we are now more or less, we're putting in some type of topping formation, depending on how it wants to go. You could say this is a shoulder, this is a head. It could form a bearish pattern here, which becomes the other shoulder. And it could break down. This could become a triple top or a double top. But more or less, David, we need to see a lot of pressure. We need to see selling back down to this threshold level, and then see if it actually starts to break below it. And of course, we're going to want to see what other assets are doing, during that time. What is gold doing? What are maybe
Yeah.
utilities doing? What's the dollar doing?
Right.
We're going to bring in a bunch of different stuff. What are large caps or small caps doing, or dividend stocks? All of those things will give us an idea of what the big investor is doing with their money and which way that money is flowing, if they're moving out or moving in still and accumulating.
It's interesting how you're talking about a breakdown of the charts before you confirm a bearish bias, right? You're not saying let's time the top. You're not saying these are the indicators that will point to a top. What is your philosophy overall on timing tops and bottoms?
Yeah, that's a good question. So I think anybody who's an active trader or investor has all probably had one or two really good scenarios where you've bought a bottom, made a fortune, or you picked a top and shorted it and you made a fortune. They are super hard to do. You win like one or two out of 10. When you lose a lot. When you win a lot, but it's not worth it. So I'm all about, identifying when a trend is losing speed, taking off partial profits. When it starts to roll over, get out and then get back in. I'm all about following the trend. And so I don't care about trying to pick a top in the market. I'm looking for these nice big trends generally from like, November up into this area. And then eventually when it stalls and runs out of speed and starts to go down based on our analysis, then I just want to get out. I don't care if I get out up here. I don't care if I get out, even down here. I'm just looking for this safe middle zone. And to get that middle zone, you have to get in later after the trend has already had a nice move up. That's when the trend is confirmed. And then you ride it up and then it loses momentum. And then you're like, oh, I think it's starting to go down. And then eventually, as it starts to go down and kicks into a downtrend, we get out, somewhere over here. So we're buying after the bottom, we're selling after the top. That's how you do it. Like that's really, unless you want to guess and try and pick, you have to get in after a trend starts and get out when it's confirmed that it's over, or else everything else really is just guessing. And if you nail a few of those guesses, you get this false belief that you can do it. And no one can really pick tops and bottoms consistently. So
Yeah,
it's just an expensive game. It makes you more active, gets your emotions going. It costs you a lot of money in the long run.
fair
I
enough.
know guys who have been trading and investing for 20, 30 years. They're part of our newsletter, and they finally are like letting go of they don't worry about the first rally. Like if you take a look at these lows, the market rallied like 7% in like a week and a half or 2 weeks,
Hmm.
and we didn't get in. And you're either in the mindset of we just missed a huge move, we should have had that, which those traders generally don't do very well because they're expecting to pick the bottom, or the trend changes gear and we move in and we catch the new wave that's rolling through, and we don't care about the 7%, and we don't care about giving back 5-6% in a market top. It's just part of trading.
Well, on that note, tell us about how you trade asset revesting. What is that for the new viewers out there? How does that work? And you kept talking about protecting your capital, protecting your wealth. How are you doing that?
Yeah. So more or less, the way I do that is if you go to the technicaltraders.com, you can go to our strategy asset revesting, and you can see how we go about doing this. But long story short is I focus on an asset hierarchy. So we always want to own whatever's at the top of the list. Usually the index has the most volatility, so we want to own it. If it's not favorable, we move to a different asset class. So if the stock market's going down, you don't want to hold a whole bunch of different sectors and stocks. They're all going to go down. So you might as well move to a different asset that's going up. It could be bonds. It could be the US dollar index. You might have to sit on the sidelines in cash if nothing meets our criteria and just collect your on average, 5% return a year right now. So we move through and we hold one or two ETFs at any given time. We hold more or less one asset class at a time. It's either stocks, bonds, or currency. And our alternate position will be some in cash as we pull off profits. And so that's the whole focus, is to only hold things that are moving up. And during COVID, this, like our strategy here, we've got them layered in. Like here's the SP 500 as it broke down. This was before we really knew COVID was a thing. The chart said, hey, get out. There's huge selling going on. We got out of the SP 500. We moved into bonds because bonds met our criteria. It rallied 19% in 9 days, hit our targets. And then we sat in cash and we collected dividend interest for another month while we waited for the stock market to strengthen. And then we bought back into the stock market and rode it up for another 18%. So at a time where most people are losing their shirts, they don't know what's going on, we not only avoided the crash, we profited from the skyrocketing bond values. And then we sat in cash collecting interest when the whole world was falling apart at that point, and we had no assets other than cash. So this is what we do: is we literally just rotate to whatever asset is going up. And as we move down this list, as the markets get more wild, we move to slower and slower assets, meaning they're less volatile. We can rest more as the world's getting crazier. And that's the whole point of the strategy. And this is kind of, what it looks like is this dark line here is I call it CGS, the consistent growth strategy. It just inches its way up the chart. From the 2008 market top, we're still outperforming the NASDAQ, the SP 500, the buy and hold, and it's just slow. We have 5 to 12 trades a year, usually one ETF position at a time, and we just hold whatever asset class is going up.
Would you call yourself would you call yourself a momentum trader?
I would say more of a trend trader, because we're identifying trends, but we use momentum, big momentum behind the scenes to say, hey, this trend has momentum behind it.
What's the difference between a trend and a momentum?
A trend means it's trending in a direction. It's going up, down, or sideways.
Yeah.
Momentum is how much power is behind it. Does that trend have a lot of money moving in? Is it moving faster? Is it trending up faster? So it's kind of the power behind something, right? It's just like when you're in the ocean surfing, you wait for those sets of waves. Those waves have momentum behind them. They got power. And so when we identify a trend, if there isn't power behind it, we don't want to jump on a little ripple. Just even though we know there's a wave coming, we're like, let's wait for something strong where there's a herd of people piling in, driving that wave, that price action of that asset. We want to jump on it when there's a swell coming.
And right now, are you saying, I think you were telling me momentum is kind of fading behind this trend? Is that what's going on right now in the stock markets?
Yeah, I think the long-term economic momentum is stalling. We can see that, I think, with unemployment and savings and all those things. But when it comes to the actual stock market itself, we're in a topping phase. The long-term trend momentum is starting to stall, but it doesn't mean the stock market can't keep going up. So even though I'm bearish, and I always see this in the comments, people are like, "Oh, he's super bearish. He's always bearish." It doesn't matter if I'm bearish or not. I'm trying to mentally protect and prepare people for what could be coming.
No, you know what it is? It's okay. I have to say something to the audience. I know a lot of people don't watch past the first minute. And so the first minute of this interview was Chris talking about how the economic momentum is slowing. Please, if you're watching this at this point, please just watch the rest of it. I think Chris is going to, give you a much, I think, holistic explanation, more rounded explanation than just the first minute. But anyway, yeah, you're right. People are calling for you to be bearish, but long term you're bearish, short term you're not, right? How much cash do you have right now?
We're 100% in the equities market.
Okay. Yes, because I ask you that every time because that rotates too. It's not always 100%. Great. I want to finish off on a few, just one or two assets. So you mentioned the TSX. The TSX is predominantly resource driven. So let's take a look at oil, WTI. It's been trading range bound the last couple of months. What's going on here?
So I'm looking at CL, the crude futures here. I mean, they've completely fallen out of bed for crude oil. We saw a bit of a bottoming formation form through here, and then it finally broke through. And it's been trying to find support here over the last month. And really just in the last few days, it just refused to find support. OPEC kind of stuck their head out there and did some production stuff. Now we got, not the best economic data starting to come out with manufacturing numbers being soft. So if production and sales and things are slowing, that means there's going to be less demand. And so investors are dumping oil. They see fear. They see slower times coming, less demand. So, I mean, it is now in a downtrend. It was clinging on. It was holding on to this kind of in this support range for about a month. And we were waiting to see if it was going to find a market and rally here. But now it is kind of broken down based on this chart pattern in Fibonacci. It's set to go down to about $70 a barrel over the next, it could happen any day at this point, the way that it's going down. But it has momentum here to get back down to these lows, which will be a fairly strong support level. It really goes through this chart way back in 2023. So if it does dip down here, I have no doubt it's going to probably find some support and bounce for a while. But I'm bearish on oil. It broke down and doesn't look the greatest here.
Okay, finally, utilities. I want to bring up utility XLU ETF. Yeah, you
Okay.
have that ready already. There's this huge rally. Is that people switching into a defensive sector, or is there something going on beneath the surface?
Yeah, this is people money wants to move into a defensive sector. Obviously, no matter what happens in the world, we still need electricity, running water, all that stuff. So people have been moving in there, and we saw this in COVID too. We saw when utilities dramatically outperformed the SP 500. We can see the last time we saw this dramatic outperformance in utilities, something bad happened, and we had the COVID crash, and we see this over and over again. Utilities will do very, very well for a little window, outperform the stock market, and then of course they crash with the stock market because something breaks in the system. Something breaks in terms of some type of news or bad economic data, or just the trend changes something. So this is definitely a little bit of a bearish sign that people are moving into this defensive sector and trying to preserve their capital. But what people don't realize, David, and this is the same with the aristocrat dividend ETFs and people who just own high dividend paying stocks, is they don't realize them and all the other passive investors who believe the same thing and are told by advisors, like, move into dividend stocks. You can just, always get dividends. The problem with dividend stocks and utilities is they sell off more than the stock market index does. So, dividend stocks sold off more than the SP 500. They dropped more than the utilities dropped more than the SP 500. They are dangerous. People don't realize these. When the market goes into a bear market, these stocks get hit.
Mm.
And the reason is the majority of stock market investors are 50 plus. They're all doing the same strategy. They're buying utilities and dividend stocks, and they all freak out and panic at the same time. They're all watching the same news. They don't understand charts, and they all dump their stocks, and they all own the same stocks. So they get hit harder than everything else. So dividend stocks are super dangerous. Utility stocks are really dangerous to hold during downturns. You're actually holding something more volatile than the stock market itself. And people don't realize it until they take the loss, and they're like, and then it's too late. They've already lost their money. But these are the things that it's painful because I see it happen over and over again. And they're like, I thought I was good. I held dividends and bank stocks, and I don't know why they got hit so hard. But this is just what happens. It's the same investors hold the same things, and they all panic at the same time.
I want to read you. I'm going to close out by reading you an article from Tech Radar. This came in response to Jensen Huang, CEO of NVIDIA, making a speech about a new product, their new Blackwell cluster, which is a new GPU. It's a cluster of 8 GPUs. It pulls apparently 15 kilowatts of power. That's 15,000 watts of power divided by 8. That's about 1,875 watts per GPU. Now, Jensen Huang is talking about 1 million Blackwell GPUs going online as part of this AI trend. Now, to give you context, that's 1.875 gigawatts of power. So basically, a Blackwell cluster is doubling the power consumption of already existing chips. A million Blackwell GPUs is going to be 1.875 is going to use 1.875 gigawatts of power. For context, a typical nuclear power plant only produces 1 gigawatt of power. What this author is trying to say is that at the current rate of scaling of GPUs, we're not going to have enough power on the grid. Right.
So, yeah, it's the end of the world. These robots are going to get so smart, so powerful. More or less, NVIDIA is going to need to get into the uranium space and have their own nuclear plants, right, to power their own product.
So potentially a reason to long utilities or uranium or other base metals, but we can discuss that in more detail next time. This is a great session already. Great market overview. Tell us where we can find your work, Chris.
Yeah, sure. People can go to thetechnicaltraders.com, and I cover the charts just like you and I did, but usually in a much more granular level and shorter term picture stuff. And I share videos and analysis and the trades that I do. I put on these ETFs and I share them with everybody else, and they can subscribe and follow along. And I usually provide a morning video before the opening bell, so everybody knows what's going on. And if there's any gaps or anything, they won't panic because they'll understand why and what it means.
Let's follow Chris in the link down below. I'll put a link to the Technical Traders. So click on that link. Thank you, Chris. We'll see you again next time.
Thanks, David. Take care.
Thank you for watching. Don't forget to like and subscribe.